What the hell's going on, guys? Today I want to talk to you guys about how I made about $200 writing a covered call or sell to option covered call on Square due in January of 2019. Now, you guys might not necessarily be too familiar with options, but let me give you a brief rundown. So, writing a call or buying a call either gives you the option to buy or sell 100 shares of stock. So, it gives you the option to control about 100 shares of stock. So, what a covered call is means currently own shares of Square. I have 100 shares, actually 107 shares of Square. And what I did was I collected a premium from someone. Someone bought say, an insurance premium to say that by 2019, January 2019, they would be able to purchase my shares that I have for $22 at $40 for giving me $2 per share to buy that. Now, the reason why someone would do that is because they are very bullish on the stock. They're basically, their thought process or their analysis shows that by 2019, January 2019, this stock will be worth more than $40 a share. Actually, more than $42 a share in order for them to break even. So what they did was they said, hey, on the open market, in the options market, I'll give you $2 to buy this in 2019. So they're basically saying, well, I'll pay $200 now, $2 a share times 100 shares, to be able to purchase those shares from you for that price. And now they would make money if, say, shares of Square go up to, say, $50, $60, because they essentially control the shares at $40 at that time period. Now, say it by February of 2019, the shares go up to $40. It doesn't matter. I'm technically able to keep that premium of, say, $200 because they didn't meet it within that threshold of, say, between today and January of 2019. So that's kind of a little bit of a rundown as to what happened. So if you want, we can get a little bit more in depth with a little bit of the actual purchases of the actual shares themselves, and then the actual call option, and then obviously talk about what my potential possibilities are to either get out of the option or what type of returns I'll make depending on what scenario happens. So my initial purchase of Square shares, I bought 107 shares of Square at $22.05, which gives me a total cost basis of around just under $2,400. So then what I did was on August 7th, I wrote a sell to open option, which means I have 100 shares already, and I'm going to essentially collect a premium from someone or sell the option or the right for someone to purchase these 100 shares for me at $40 between now and any time in January 19. Now they could technically exercise this at the moment if they wanted to, but then they would be at a loss of, say, 17 or so dollars per share. So what happened? The buyer of the call, so buy to open call, essentially pays me $2.05 for the right to purchase that, right? Which in turn gives me $205. Which, how does that happen? $205 a share is what the option call was for, and you multiply by 100 shares, you get $205. So after commissions and everything, I made $199 off commission. Now I can technically do whatever I want with that. I could, go buy groceries with that, or I could, go buy some more shares of something if I wanted to, or I could just sit on it and just keep it in my account. So in all reality, I can do what I want. So here's a little bit more of a rundown. Purchased at $22.05 in the May time period, and essentially we're banking on the fact that technically what I'm saying is I'm bearish that the stock won't go to $40, but bearish kind of makes it seem like I'm more hesitant. I like the stock, I own the stock, but at the same time it doesn't pay a dividend, so I'm trying to earn extra income between now and, say, January 2019 in order to increase my returns. I personally don't think that $40 is the right price for it. I think at that point it gets into like the 25 to $30 billion range of total market cap. And I think where Square is, although it's doing phenomenally, I don't believe that it is currently should be valued at that total market capitalization. But in the end, I could be wrong. So what are the possible outcomes, right? So the buyer of the option can call away my shares at $40 between now and January 2019. Now this would only be smart for him if, say, the shares go to $42 because he's already purchased the strike option for the strike at $40, and he's already paid me $2 to do that. So technically, he would only make money if, say, the shares go up to $43 between now and January, or $42.01 or whatnot. But anyway, regardless, so what does that mean for me, right? So say this actually ends up happening and they get called away at, say, $40. So I purchased my shares at $22.05, and they will be called away at $40. So I technically get that $40 per share. So I get $17.95 per share times 100 shares. It gets me, $17.95 in total capital gains, plus the $200 option, right? So that gives me an 85% return in just over a year and a half. Now this isn't guaranteed to happen, right? So the shares actually have to go to, say, $40, $41, $42 a share. Now say they do go to $42 a share and they exercise this, I only get to sell it at, say, $40 a share. But it is kind of nice because they probably won't make any money unless it goes to, say, $42 a share or so. So technically, even if the shares go to $40, they may not exercise it, and I can still technically keep this money. Another option, or outcome rather, that ends up happening is the option expires worthless. The shares never hit $40 between now and January of 2019, and I keep this $200 option premium. That's pretty simple. You just essentially take the money, the $200 option, divided by what the cost basis was, which was just under $2,400. That's an 8.5% return in just under a year and a half, or just over a year and a half, sorry. Which is a pretty good dividend payment if you think about it. Good dividend payment yearly would be 4%. Square doesn't pay a dividend, so an 8.5% return on top of whatever I make, is pretty nice. Another option is buy to close the Square 2019 January call at $40 for profit or loss in order to cancel the option. So kind of get into this more a little bit later, but currently the option is actually going for $1.85. So if I paid $185, I could close that option and just keep my shares at what they were, and I'd make a 10% return. 10% meaning because I'd still have to pay a little bit of commissions associated with this. But in all reality, I'd technically up like 14.5% off of this current option. Or say the option goes up to $35 and or the actual Square price goes up to $35, and it's December of 2018 and I don't want to get rid of it, and the actual call itself is selling for, say $2.20. Then I could be like, well, I don't really necessarily want to get rid of the shares. I think it's making a really good bull run. It might go to 50 in the next couple months. I could buy that back, and if you think about it, it'd probably be a loss of, say, $15, but not of the total, or 15% rather, and not of the total shares that I own, but just of what I purchased the $200 for. So I'd essentially lose, say, $15 associated with this. So I'd have to pay the $200 option back plus, say, $30 or so $2.30 per share of whatever it needs to be in order to cancel that option. So that's kind of two things about it. So, and getting a little bit more in depth, so let's look at what I have currently. So I have my Square shares, as you guys see. I don't know why it went away, but Square shares purchased cost basis at $22.05, which is very good. Currently they're at $24. They were hovering around the $27 range at one point, but have come back down. That's coincidentally, I think, when I sold the call itself. And then I have my covered call, which ended up being $1.99 per share. Sold it at $2.05, but obviously after commissions, you get to take some of that away. You guys might be familiar with commissions. They take a decent amount of your money. So like you guys see here, the buy to close would cost me $185 in total value, or $1.85 per share. So currently I'm looking at a $14 gain or so. But what I currently have for sell or for my activities is I actually have it set for $1.45 per share, and so afterwards that would get me about a or so, 25% return if that gets executed. So currently, I think the sell to open is going for about 100 or $1.65, and the buy to close is going for about $1.85. So if there's any more negative movement or the time decay in the actual stock itself um, goes down, then I can essentially guarantee myself being able to get closer to that $1.45 or so to cancel the actual and buy it back. So I would pay $145, but I got paid $200 to get the option in the first place. So I'd be able to pocket the difference between that. So actually looking at this, kind of on a graphic, right? So if you're just buying and selling the option, this is kind of misleading. If you're just buying and selling the option, this is going to tell you what the option value is going to be worth. Obviously, the closer it gets to $40, the more, I missed out on, you could say. So this is kind of misleading. But if you think about it, okay, so I sold it for $2.05. You can see that down here. And afterwards, it ended up being $199 or so in order to execute that trade. But the closer I get to the actual option period, the less profit I'm missing out on per se. And that's what we call time decay. But you can see the closer that you get to the time, so 125 days to expire, this curve is getting a lot sharper towards the $40 range, basically saying that it's less and less likely within that time period that you would be getting to that $40 strike period in order to execute this trade. And so essentially it's getting closer and closer that I'd be able to keep my premium, right? To the point where on the actual day itself, it's a straight line. So I'm basically keeping all this premium until until you actually go above 40. And this negative isn't necessarily a negative. It's just saying this is money you left on the table, right? So you'd still make money on paper, and you'd still be able to go to the bank and make that money, but you missed out on, say, $500 a share, or $5 a share, or $2.50 a share, or in this case $3 a share, because you essentially, the strike price is $40 plus the $200 that you got, so that's why it's negative 300, right? So it's at $45. You're technically missing out on the $3 per share between $42 and $45, and so that's what it is, right? So hopefully this makes sense, and I'll keep you guys posted. I've bought a couple options to open pretty recently, some in GE, and I tried buying and selling some other ones. I think I'm limited to sell to open and buy to open calls. I don't believe I have the ability to buy any puts or sell any puts yet. But if you guys are not really familiar with options, you'd like me to do some videos, feel free to leave down a comment leave a comment down below, and I'll be more than happy to talk to you guys through it. By no means am I an expert. I'm just recently getting into options, and I've done a couple before where I've lost 10%, and then one where I've actually made about 40% off of a $100 option. So by no means am I an expert. I've only really probably done 3 or 4 of them, but we're in this journey together. It's a community where we can talk and discuss anything financial, personal finance, or anything like that. So feel free to like, subscribe, leave comments down below, and I'll try to get back to you guys as soon as I can. And hopefully you guys learned something from this video. If not, I'll talk to you guys soon, and enjoy the rest of your weekend.